The butcher, the banker, and the bartender. A butcher, a banker, and a bartender walk into a bar. The butcher says, "My meat prices are up 12%. The banker says, "My bonuses are up 40%. The bartender says, "My rent is up 18%. And somewhere in the background, your savings are worth less than last year." The banker buys around. The butcher and bartender split the tip. That's not a joke. That's the American economy since 2020. In December 2025, the Federal Reserve quietly ended its multi-year campaign of quantitative tightening. No letter in your mailbox, no dramatic announcement, no Super Bowl ad. They just stopped. Front page news to almost nobody. But your grocery bill noticed. Your landlord noticed. Your savings account definitely noticed. The question is, did you? Today I'm going to explain how money actually moves in this country, why the system keeps resetting when wealthy institutions wobble, and what you realistically can do before the next reset lands on your lap. No conspiracy theories, no get-rich-quick fantasies, just incentives, and the boring documents nobody reads. Meet Marcus. Let me tell you about Marcus. Marcus works in logistics, makes $78,000 a year, lives in Ohio, does everything right. He saves 15% of his income, keeps it in a high-yield savings account, avoids credit card debt, has an emergency fund. Marcus thinks he's playing it safe. Marcus is slowly being robbed, and the thief has a very nice office in Washington. The poker table. Picture this: 7 players at a poker table. Under the table, the dealer has a printing press. Every time the game slows down, the dealer prints more chips and hands them to the big players. The big players bet bigger. The pot grows. Everyone thinks the game is booming. But every new chip slightly reduces the value of the old ones. The small stacks shrink in real value. The big stacks grow in nominal value. The dealer calls it stimulus. The small players call it inflation. The big players don't call it anything. They're busy buying vacation homes. You might think, this sounds like crypto bro nonsense. The Fed doesn't print money for rich people. Technically correct. They print money to buy assets. Here's the awkward question. Who owns the assets? The balance sheet explosion. In early 2020, the Federal Reserve owned about $4.2 trillion in assets, treasuries, mortgage-backed securities, bonds. Then the pandemic hit. The Fed didn't print a little money, they printed roughly $4 trillion in 2 years. By early 2022, the balance sheet ballooned to nearly $9 trillion. When the Fed buys bonds, they aren't buying them from you. They're buying them from banks, institutional investors, asset managers, entities that already hold billions. The Fed hands them cash, and what do? They lend it, they invest it, they buy stocks, they buy real estate, they buy anything that rises faster than inflation. Meanwhile, Marcus earns 3 to 4% interest while inflation runs higher. He loses purchasing power responsibly. Phase 1. Asset inflation. Between 2020 and 2022, U.S. home prices rose roughly 30% nationally, in some areas 50%. The S&P 500 returned 18% in 2020 and 28% in 2021. Historical average? Around 10%. Inject $4 trillion into financial markets and surprise, asset prices surge. If you owned a home, congratulations. If you owned stocks, congratulations. If you were saving for your first home, your down payment jumped from $60,000 to $90,000, while your salary rose 5%. Same economy, different outcomes. Inflation isn't equal. If you're worth $10 million and inflation is 7%, your expenses rise maybe $30,000. If your assets appreciate 15%, your wealth rises $1.5 million. You're not hurt, you're mildly inconvenienced. If you're worth $10,000, your expenses rise $3,000. Your savings earn 2%. You fall behind every month. Inflation doesn't hit equally. It magnifies inequality. Phase 2, the reversal. By mid-2022, inflation hit 9%, the highest in 4 decades. Suddenly, the Fed panicked. They stopped buying bonds, they let bonds mature, they raised rates at record speed. The dealers stopped printing chips and started removing them. Between 2022 and late 2025, the balance sheet shrank from $9 trillion to about $6.5 trillion, $2.4 trillion in liquidity removed. Sounds responsible, but here's the problem. They didn't fix the structure, they just hit pause. Phase 3, the quiet bailout. December 11, 2025. The Fed announced reserve management purchases, not quantitative easing. No, totally different. QE equals buying long-term bonds. Reserve management equals buying short-term treasuries. Both involve printing money to buy assets. One sounds scary, one sounds boring. They chose boring. History shows us something. Temporary programs have a habit of expanding when markets get nervous. Same pattern. Crisis, bailout. It's temporary, expansion. Repeat. Too big to fail. Late 1990s, long-term capital management. Nobel Prize winners, mathematical geniuses. They borrowed billions. The bets went wrong. The Fed orchestrated a rescue, not because they cared about the partners, because they feared systemic collapse. Lesson learned, fail big and loudly, you get rescued. Fail small and quietly, you get a lecture about responsibility. Marcus loses his job, should have planned better. Major bank faces insolvency, $300,000 appears overnight. Political pressure. Every politician wants low rates. Low rates equals cheap borrowing. Cheap borrowing equals more spending. More spending equals growth on paper. Growth on paper equals re-election. The Fed is supposed to be independent, but independence relies on norms, and norms erode. The path of least resistance? More liquidity, more asset inflation, more concentration of wealth. So what do? You can't control the Fed. You can control your positioning. Let's use real numbers. $50,000 in savings at 4% equals $2,000 per year. Inflation at 3.5% equals real return near zero. After taxes, negative. Now invest that same $50,000 at 7% annually. After 10 years, roughly $98,000. That's a $48,000 difference. And companies can raise prices during inflation, which helps stocks keep pace. 2 piles. Your wealth lives in 2 piles. Pile 1, labor, your salary, your time, your energy. Pile 2, capital, your ownership, your assets. Over the last century, labor struggles against inflation. Capital compounds with inflation. When money is printed, it flows into assets first. By the time prices rise at the grocery store, institutional money has already bid up farmland, equities, and real estate. The dual mandate problem. The Fed has a dual mandate: maximum employment and stable prices. That's like telling a restaurant, serve maximum portions and minimum calories. At some point, you choose. Yes, index funds are magic. They are a bet on long-term economic growth. They work because profits grow, but they require time. Money needed in 2 years, not stocks. Money needed in 20 years, historically, mostly stocks. Fees matter. Expense ratios matter. Behavior matters most. The biggest risk isn't the Fed, it's your own panic. The most active traders historically earn the lowest returns. The least active earn the highest, roughly a 7% annual difference. Over 20 years, that's life-changing.
What about CBDCs, currency collapse? Digital currencies? Being explored. Possible? Yes. Certain? No. Dollar collapse? Extremely unlikely short term. Estimated 60% of global reserves are in dollars. Estimated 88% of FX trades involve dollars. If it collapses, everyone suffers. The more realistic scenario? Slow erosion over decades. That's already been happening. The dollar from 1913 is worth about 3 cents today, but wages and assets rose alongside it. The key question: do your assets rise with it? 3 practical moves. Calculate your personal inflation rate. CPI is average. Your life isn't. Automate investing. Make it boring, invisible, systematic. Match assets to timeline. Short-term money equals safe. Long-term money equals productive assets. Final thought. Back to the butcher, banker, bartender. The butcher raised prices. The banker bought assets. The bartender started investing. 2 adapted. 1 complained. The system isn't fair. The dealer has a printing press. But you don't need to own the casino to win. You just need to stop playing like a tourist. The next reset will come. Maybe it's a bailout. Maybe a rate cut. Maybe a new acronym nobody's invented yet. When it does, asset owners will adjust. Cash savers will wonder what happened. Don't be in the second group.